Hello CA final students. In this video, we are going to discuss all the concepts, provisions and study material questions of Ind AS 23 borrowing cost. So it's not a new area for you. You have already studied the standard in your intermediate level AS 16. So very similar provisions are there in Ind AS 23. But if you are somebody who's like, I don't remember the provisions of AS 16, let's start from the scratch. So, borrowing cost. What is borrowing cost? Borrowing cost means any cost incurred in connection with the borrowings or arrangement of borrowings from the date of loan till the date of repayment of that loan. Whatever expenses or whatever cost you incur in connection with this borrowing is borrowing cost. Correct. So, cost incurred in connection with the borrowing. Cost incurred in connection with the borrowings is borrowing cost. And what is the treatment of this borrowing cost? You can say borrowing cost should be transferred to statement of P&L. But this standard says no, there are two treatments for borrowing cost. You cannot say always borrowing cost to be transferred to statement of P&L. If you say it is not correct, borrowing cost have two treatments. What are the two treatments? If borrowing cost is incurred for a qualifying asset. If borrowing cost is incurred for qualifying asset. What is a qualifying asset? Qualifying asset is an asset that takes substantial period of time for its intended use. Qualifying asset is an asset that takes substantial period of time for its intended use. So this standard says if borrowing cost directly attributable towards, I want you to learn this line, borrowing cost directly attributable towards, borrowing cost directly attributable towards acquisition, construction and production. Acquisition, construction, production. Borrowing cost directly attributable towards acquisition, construction and production of a qualifying asset needs to be capitalized. Borrowing cost directly attributable towards acquisition, construction and production ACP of a qualifying asset needs to be capitalized. So what is a qualifying asset? Qualifying asset is an asset that takes substantial period of time for its intended use. Example, if I am constructing a building, I'm constructing a two-storied building, two-floor building. Say for example, it has taken 12 months for the construction. Then we can say for the construction of the building, 12 months time is taken for my intended use, which is substantial period of time. So what is the substantial period of time? Is it 12 months? It's not defined. It's not defined in the Ind AS standard. It's not saying anything. It is as per the judgment of the entity. So it is not defined, it is as per the judgment of the entity. So if you get a question, what my suggestion is, if up to 6 months, assume not substantial period. It is better to assume it is not substantial period. Up to 6 months, it is better assume as not substantial period. But if it is 6 to 12 months, you assume as substantial period. Even more than 12 months, you need not assume, it is understood that it is substantial period of time. Understood that it is substantial period of time. So up to 6 months, don't take it as substantial period of time. If it is 7 months, 8 months, 9 months, 10 months, 11 months, 12 months, assume it as substantial period. More than 12 months, it is understood, no need to even go for assumption. Okay, so that is clear. So first point, areas to be covered. First point is what is borrowing cost, discussed in the standard. If borrowing cost directly attributable towards acquisition, construction and production of a qualifying asset, it requires to be capitalized. It requires to be capitalized. In other cases, not for a qualifying asset. Example, if building I acquired, I am acquiring a building which is ready to use condition. I am acquiring a building which is already ready to use. Then there is no substantial period of time for my intended use. It is already ready to use. Or you have taken a loan for working capital purpose. You have taken loan for some other purpose. Other assets, not qualifying assets. Then it should be charged to statement of P&L. It should be charged to statement of P&L. So still I don't have clarity what are qualifying assets. That we discuss, qualifying assets are assets that take substantial period of time for its intended use. But Ind AS 23 is not giving you a list. Okay, these are the items which are qualifying assets. These items are not qualifying assets. So such a list is not given by the standard. So what should I do? You need to find out, okay, this is the date when you spend amount for the asset. Even if I spend amount on the asset, it is not ready for my intended purpose, intended use. So I need to wait. The waiting period is substantial period. So generally, these are the qualifying assets. PPEs can be qualifying assets. PPEs can be plant and machinery I acquired, but not ready to use. I need to assemble the parts. But for assembling the parts, it requires 8 months time. And I'm assuming that is substantial period of time. But if I am acquiring a plant and machinery which is ready to use, not a qualifying asset. So PPEs can be qualifying assets. Investment properties, building, construction of building can be qualifying asset. Investment properties can be qualifying asset. Intangible assets can be qualifying assets. Inventories can be qualifying asset, but there is an exception for inventories which we will discuss now. So generally a PPE, you need to check you are acquiring a PPE, constructing a PPE against which there is a loan, and that PPE takes substantial period of time. Then you can apply this Ind AS 23 provisions. Investment properties, you are constructing a building which takes substantial period of time and there is a loan against that building. So there is a possibility you need to check whether substantial period of time is there, qualifying asset, then you can capitalize interest also to the value of that building. Intangible assets and inventories. But there are two exceptions which I am writing here. I want you to write exceptions, two exceptions. Ind AS 23 does not apply to. Ind AS 23 does not apply. Ind AS 23 does not apply to 1. Assets which are measured at fair value. If assets are already measured at fair value, then you cannot again capitalize that borrowing cost. Like Ind AS 41, agricultural activities, biological assets, which are measured at fair value less cost to sell. If there is a borrowing cost incurred on that asset also, you cannot capitalize because it's already measured at fair value. You cannot further capitalize borrowing cost. Then inventories that are manufactured. Inventories that are manufactured in large quantities. on repetitive basis. Inventories which are manufactured in large quantities on repetitive basis. So my standard says then it is very difficult for me to identify borrowing cost on incurred on 100 inventories. But that is keep on manufacturing on large quantities on repetitive basis. Then how will you allocate borrowing cost of that 100? If that one-to-one relation of that borrowing cost to that particular asset, that cannot be done. It is difficult. So inventories that are manufactured on manufactured in large quantities on repetitive basis, it is an exception. You cannot capitalize. Okay, fine. You cannot add to the cost of that inventory. So Ind AS 23 talks about capitalization of borrowing costs. They are giving the idea about what is a qualifying asset and what is substantial period of time. What is the treatment of borrowing cost? Borrowing cost can be capitalized if it is for qualifying asset. In other cases, it should be charged to statement of P&L. Okay, fine. So qualifying assets can be PPEs, intangible assets, investment properties and inventories, but there is an exception to inventories. Up to that, okay. Now computation. So if there is a loan, okay, so there is a loan. There is a loan, 5 lakhs which I have taken for the construction of a building. I'm constructing a building. Building will take 2 years. Building will take almost 2 years to construct. So my standard Ind AS 16. As per Ind AS 16, all directly attributable expenditures can be directly attributable expenditure for bringing the building into present location condition can be capitalized. Yes or no? During that 2 years construction period, whatever directly attributable expenditures you are incurring for bringing the asset into present location condition can be capitalized. Yes. So if this building is funded using a loan, my standard is asking what about interest on loan during the construction period? That interest cost is incurring for the construction of the building because the loan is for constructing the building. So what about interest? Interest also forms part of the directly attributable expenditure. So interest can be capitalized. This is the background. So that interest on loan, if the loan is used for the construction of the building, then interest on that loan also can be capitalized. This is the background or the concept. Okay. Now, how do we calculate that borrowing cost to be capitalized? How do we calculate the borrowing cost to be capitalized? So 1, 2, we are going to find out what are the types of borrowing and the amount of capitalization. So understand, for the purpose of computing the amount of borrowing cost to be capitalized, for computing the amount of borrowing cost to be capitalized, for the purpose of computing the amount of borrowing cost to be capitalized, borrowings are divided into two. One is general borrowing and specific borrowing. What is a specific borrowing? If the amount is borrowed specifically for acquisition or construction of a qualifying asset, if that borrowing is specifically for the acquisition or construction of a qualifying asset, then borrowing cost on that specific then that is what called as specific borrowing. Amount borrowed specifically for acquisition or construction of a qualifying asset. Then what is general? Not specific. That borrowing which can be used for any purpose. You have a borrowing, but that is not for construction of a qualifying asset. So that's a general borrowing. Okay. Now, if specific borrowing, what is the calculation? If it is a specific borrowing, what is the amount of borrowing cost that can be capitalized? Listen carefully, focus. If specific borrowing, Actual interest cost incurred on the borrowing. Specifically during which period? Entire standard talks about only during the construction period. Okay, that is understood. What is the interest cost during the construction period? Actual interest cost on the borrowing minus investment income on temporary investments. Investment income on temporary investments. Not clear, not clear. I'm getting confused. I'm not clear. Okay, then we'll take a question. In our material, page number, not page number, question number 8. Let's take this question number 8. That's in page number 57. This is our study, almost all the questions are study material questions only. So question number 8, please focus. Alpha, this is to understand, okay, if there is a specific borrowing, how do I calculate the interest cost? Alpha Limited on 1st April 2011 borrowed 9% 30 lakhs to finance the construction of 2 qualifying assets. Okay, you have taken one loan, it is a 9% loan. That 9% loan I have taken for 9% loan 30 lakhs. This is taken for the construction of 2 assets. Now construction started on 1st April 11. The loan facility was availed on 1st April 11 and was utilized as follows, and the remaining funds invested temporarily at 7% interest. If any fund is unused, it is invested at 7% interest. You are using that 30 lakhs for construction of factory building and office building. Factory building on 1st April you used 5 lakhs. Then 1st October you used 5 lakhs, which means first 6 months only 5 lakhs is used. Total factory building cost is 10 lakhs. Total cost of factory building is 10 lakhs, of which 5 lakhs is used in the first 6 months. Next 6 months only next 5 lakhs is used, which means first 6 months 5 lakhs was idle. Out of 10 only 5 you have used. 5 was idle. Yes or no? And office building total cost is 20 lakhs, of which first 6 months you used 10 lakhs. Next 6 months only this next 10 lakhs is used, which means this next 10 lakhs, I mean that the 10 lakhs which you used on 1st October was idle during the first 6 months. So how do you calculate the borrowing cost to be capitalized? Easy. So first I am taking factory building. Actually calculations and the notes are there, but I'm just doing factory building. Total fund 10 lakhs into what is the interest rate? 9%. So that is 90,000. This is the actual interest. Okay. Now less investment income. Investment income, that is 5 lakhs into 7% income you would have received for 6 months. 5 lakhs into 7% into 17,500. 72,500. So we are assuming that construction of the factory building is for 12 months. So entire 90,000 you could have capitalized, but I have not used entire 10 lakhs during 12 months. That 5 lakhs was idle, on which I earned interest 17,500. This is my expense. This is my income. So net interest that can be capitalized is only 72,500. So total cost of my factory building will be 10 lakh 72,500. Are you clear? So 90,000, 17,500. So 10 lakhs, 72,500. So my entry will be like this: interest only on factory building, interest to interest payable, or if interest is already paid, bank 72,500. Then of factory building, 10 lakh 72,500 to bank, 10 lakhs to interest. Or I could have passed interest to bank. So combine factory building to bank 10 lakh 72,500. Alternatively, I could have passed the journal entry. But this makes more sense. Instead of charging interest to P&L, I have debited to building. Same is the calculation for office building. If you can go through, that will be great. I mean, like 10 lakhs plus 10 lakhs, total fund is 20 lakhs. 20 lakhs into 9%. Let's see the calculations. 20 lakhs into 9%, 1,80,000. And on the next 10 lakhs, I used only after 6 months, which means for 6 months it was idle. Definitely, I am incurring expense and I am getting income. So net only I am capitalizing. Are you clear? Is there a doubt? If there is a doubt, please comment below. I'll clarify it. Okay. So that is with regard to what? What are we talking about? We are discussing specific borrowing. If there is a specific borrowing, then I need to calculate the actual interest. Actual. If one more example, if I can roughly, if I can give you an example, listen. I've taken a loan of 10 crore. I used only 2 crore this year. On the qualifying asset, I have used only 2 crore. I've taken a loan of 10. But I used only 2 crores. Asset constructed only for 2 crore. So how much interest I can capitalize? 10 crore into rate. Assuming entire 12 months the loan and construction is there, 10 crore into rate. Okay. So I'll get the actual interest. Then minus. I need to find out 8 crore is remaining idle, right? If this includes 8 crores interest also, correct. But 8 crore was remaining idle. So I would have earned interest on that 8 crore. I would have invested it somewhere. Or on my SB account, this 8 crore would have received some interest. So deduct interest income. So balance is the interest that can be capitalized. Are you clear? That is what actual interest. What is the theory? Theory is, let me see, the theory is where is it? If specific borrowing, actual interest incurred, interest cost incurred on the borrowing, actual interest cost incurred on the borrowing minus investment income on temporary investments. Okay, so if there is specific borrowing, what is the calculation? So if there is specific borrowing, in case of specific borrowing, interest is calculated from, if a date is not given, I'll start, interest will be calculated from opening date or date of loan. Opening date or date of loan, whichever is later. If 1st April is my starting date, but loan is taken from 1st June, then interest will be calculated from 1st June, whichever is later. Then nothing is mentioned, I'll assume it is from the beginning, 1st April. So opening date or date of loan, whichever is later, to, I'll write here itself, to the closing date. or cessation date. Cessation date of capitalization. What is cessation date of capitalization? We'll see that. Cessation date of capitalization. Whichever is, come on guys, apply your mind. Whichever is, closing date is 31st March. But my cessation date means construction ended on 31st January. Then my capitalization will end on 31st January because only during the construction period I can capitalize. So whichever is earlier. So I am highlighting this, whichever is later and whichever is earlier. Okay. Then, okay, if borrowing cost is taken for specific borrowing is for two assets. Allocate borrowing cost in the ratio of expenditure incurred. Total interest I'll calculate in the ratio of office building, factory building. What is the ratio? If they have not specifically given, in the ratio of that expenditure incurred, cost of factory building and office building, I'll allocate the borrowing cost. Okay. So this is with regard to specific borrowing. Guys, are you okay? No, I am not okay. Okay, then let's try more questions. Okay. Now, so that's with regard to specific borrowing, nothing more. If there is a specific borrowing, compute actual interest. Actual interest means from the date of loan to the date of cessation of borrowing cost capitalization uh, minus any interest incomes received. That's it. Now, in case of general borrowing, compute weighted average borrowing rate. Or this weighted average borrowing rate is also called as capitalization rate. Then I'm using red color. If there are more than one loan. If there are more than one loan, if there are more loans, not one loan, it is three loans we have, two loans we have, then weighted average borrowing rate or capitalization rate. Okay. Interest is computed from opening date or date of expenditure incurred till closing date or date of cessation of capitalization, when I should stop capitalization, when the construction ended, date of cessation of capitalization, whichever is, here it is whichever is earlier, here whichever is later. So let's understand the concept of weighted average borrowing rate or what are general borrowings with the help of examples. So please listen, question number 1. X Limited has a treasury. All these are study material questions. X Limited has treasury department that arranges funds for all the requirements of the company, including funds for working capital and expansion programs. During the year ended 31st March 2012, the company commenced the construction of a qualifying asset and incurred the following expenditure. So on qualifying asset, we have incurred an expenditure of 2,50,000 and on 1st July and 1st December 3 lakhs. The details of borrowings and interest thereon are as under. we have a long-term loan at 10%, average balance 10 lakhs and 10%, so 1 lakh. Maybe the loan is outstanding for 12 months, so 10 lakhs into 10%, 1 lakh, and there is a working capital loan of 5 lakhs and interest is 1,65,000. Compute borrowing cost that need to be capitalized. So from the question we need to understand, we are constructing a qualifying asset, and for qualifying asset we have incurred 5,50,000 rupees, and we have outstanding loan of 15 lakhs. On that we incurred a borrowing cost of 1,65,000. So how much borrowing cost needs to be capitalized? If this is a 4 marks question or a 5 marks question, how should I answer? First I should write the introduction. First, I should write the introduction. What introduction? As per Ind AS 23. Borrowing cost directly attributable to acquisition, construction, production of a qualifying asset can be capitalized. Now, if general borrowing, weighted average borrowing rate need to be identified, and in case of specific borrowing, the actual interest minus income from short-term investments is the amount that can be capitalized. Now, from the question, we need to identify some information. So, this is the introduction part. Now, discussion. What do you mean by discussion? From the question, we need to write what you understood, whether it is specific borrowing or general borrowing. There is no information that this loan is taken for the construction of qualifying asset. There is no information given. And there is more than one loan. So what we should do? We should calculate weighted average borrowing rate. How to calculate weighted average borrowing rate? Easy. So weighted average borrowing rate is capitalization rate. Capitalization rate is weighted average borrowing rate. Our borrowing cost divided by total borrowings, weighted borrowings. So weighted average borrowing rate is 11%. Now in case of general borrowing, we have used this fund only from 1st July or only on 1st July. So 2,50,000 into 11% into July onwards. So April, May, June, 3 months, no need to capitalize. Therefore 9 by 12. And 3 lakhs into 11% into this is 31st March year ending date. Therefore December, Jan, Feb, March, 4 by 12. 11% for 9 months, 11% for 4 months. Total interest that can be capitalized is 31,625. Out of this 1,65,000, 31,625 is capitalized and the balance will be transferred to P&L. Did you understand? Means I will pass the journal entry. If interest is paid, interest to bank. Interest to bank or interest to payable. Yes. Now I'll pass my second journal entry as asset account debit 31,625, P&L account debit for the balance to interest 1,65,000. This is what charged to P&L. What is not capitalized will be charged to P&L. Are you clear? Is it okay? That is what weighted average borrowing rate. If it is not clear, I need more examples. Okay, please come. Beta Limited had the following loans in place at the end of 31st March 2012. These are the loans of Beta. 18% bank loan, 1,000 year-end limits 1,000, which means it's not paid, fully outstanding. 16% term loan also 3,000, 3,000. 14% debentures 2,000. So beginning it is not there. It is issued during the year. 14% debentures was issued to fund the construction of office building on 1st July 2001. But the development activities has yet to be started. So this is debentures is a specific borrowing. Debentures is a specific borrowing because it is issued to fund the construction of office building on 1st July 2011, but the development activities has yet to be started. On 1st April 2011, Beta Limited began the construction of plant, being a qualifying asset using the existing borrowings. Okay, using this borrowings, they have constructed a plant. Expenditure drawn is 5 lakhs on 1st April and 25 lakhs on 1st January 2012. Calculate the borrowing cost that can be capitalized for the plant. So here how much is the borrowing cost to be capitalized? So borrowing cost to be capitalized. So here I am finding out there are two loans which you have already taken. So the plant is constructed using the funds out of that general borrowings which already we have. So first I need to calculate weighted average borrowing rate. Weighted average borrowing rate. Weighted average borrowing rate is 1000 into 18 percentage is the interest rate on the first loan and 3000 into 16 percentage. And this is taken, this loan is outstanding for the full year. So full year interest we need to calculate divided by this 1000 into 12 by 12 it is outstanding and 3000 into 12 by 12. So you could have taken the total of 1000 and 3000, 4000. Instead we did this calculation. So here it is 180 plus 3000 into 16%. 480 divided by 4000, that is coming to divided by 4000, 16.5%. So in case of general borrowing, my step number 1 is always calculating weighted average borrowing rate, or this weighted average borrowing rate is what called as capitalization rate. This is called as capitalization rate. So my first step is computation of this capitalization rate. Then capitalization rate I calculated. What is my next step? Next step, we'll find out for the plant, we spent 5 lakhs on 1st April. So figures are in thousands. So already we have 10 lakhs and 30 lakhs. And we used 5 lakhs on 1st April. So should I capitalize the entire borrowing cost? No. How much I used for this qualifying asset only will be capitalized. 5 lakhs and 25 lakhs. So 5 lakhs amount that can be capitalized. Amount that can be capitalized 1st April. 5 lakhs is withdrawn. Therefore, 5 lakhs into 16.5% into 12 by 12. Because that is 1st April I spent this amount. Then on which date? 31st December. 1st January. 1st January 2012. 1st January 2012 and this is 1st April 2011. So here 25 lakhs into 16.5% into 3 by 12. 82,500. 1,03,125. 1,85,625. This is the borrowing cost that can be capitalized. Okay. So before moving into next area, we'll try one more question on that capitalization rate. Listen, this is a November 2019 question asked for 8 marks, and this is also there in your test your knowledge. So please listen. An entity constructs a new head office building commencing on 1st September 2011. Entity constructs a new head office building commencing on 1st September, which continues till 31st December year end and is expected to go beyond a year, which means it's a qualifying asset. We are constructing a head office building. Work started on 1st September. Current year, September, October, November, December, 4 months. A construction period. Current year is 4 months and it is expected to go beyond a year. So no doubt it is a qualifying asset. Directly attributable expenditure at the beginning of the month on this asset are 1 lakh in September, 2,50,000 in each of the months to October, November, December. So totally we have spent 1 lakh in September and 3 months 2,50,000 means 7,50,000. So totally we have spent 8,50,000 on this asset in the current year 4 months period. So far there is no information about the loan. So next paragraph, the entity has not taken any specific borrowing. So there is no specific borrowing to finance the construction of the asset, but it has incurred finance cost on its general borrowing during the construction period. During the year, the entity has issued 10% debentures with face value of 20 lakhs. Okay. And has an overdraft of 5 lakhs which increased to 7,50,000 in December 2011. Interest was paid on overdraft at 15% until 1st October. Then the rate increased to 16. Listen carefully. It is actually very simple, but you need some concentration. What are the loans outstanding? 10% debentures with face value of 20 lakhs. Okay. So that is outstanding. Let's assume from the beginning of the year. If nothing is given, 10% debentures is outstanding from beginning of the year. So 12 months period. This 10% debentures is there. Then an overdraft of 5 lakhs which has increased to 7 lakh 50 in December 2011. Okay. So 5 lakhs was the overdraft but increased to 7 lakh 50,000 in the last month. Interest was paid on overdraft at 15% until 1st October. So it was 15% overdraft. If it is from the commencement, that is from 1st January, Jan, Feb, March, April, May, June, July, August, September, 9 months. It was 15% overdraft, 5 lakhs. Are you all listening? 15% overdraft for 9 months. Okay, fine. Then it on until 1st October, then the rate increased to 16%. Then it has become 16% overdraft in October, November, December. But I'll take 5 lakhs for October and November. Why I'm not taking December also? October, November, December it is 16%. But why I'm not taking December? In December it is 16% only, but the amount has become 7,50,000. I need to have this breakup. Clearly, you need to listen the question, read the question carefully. For how many months? If it is general borrowing, I need to calculate weighted average borrowing rate or capitalization rate. For that, I need this clear bifurcation. What amount, what interest, how many months. So this bifurcation, this is what required. Calculate capitalization rate. That's it. So what is my calculation? 10% debentures. See, we have bifurcated, we have identified. So 20 lakhs into 10%. Once this is done, 20 lakhs into 10% for full year. 5 lakhs into 15% for 9 by 12. 5 lakhs into 16% for 2 by 12. 7,50,000 into 16% for 1 by 12. So we calculated the interest and we are calculating the weighted average amount. Weighted average amount is 2,79,500
583 is the interest, divided by 20 lakhs is therefore full year. 5 lakhs into 9 by 12. 5 lakhs into 2 by 12 plus 7 lakh 50,000 into 1 by 12. This is, so you compute the interest. Interest I calculated. Okay. Second step is weighted average. Instead of weighted average borrowings, we need to calculate. So 20 lakhs whole year. 5 lakhs into 9 by 12. 5 lakhs into 2 by 12 and 7 lakh 50,000 into 1 by 12. So weighted average borrowing cost is equal to weighted average interest divided by weighted average borrowings. So 11.09% per annum.
However, this can also be done if you go through the study material, if you go through the suggested answers, you can find another answer. I mean, calculated not for 12 months, calculated only for that 4 months construction period. This is 11.09% per annum. You could have calculated a rate for that 4 months. How? Same like 10% debentures I'll be taking only for 4 months. So accordingly, I'll be calculating 4 months interest. 2 lakhs into 4 by 12. 66,667. Then bank overdraft instead of 9 months, only for September, 1 month. So that is 5 lakhs into 15% into 1 by 12, that is 6,250. This is for 2 months, September and October. So 5 lakhs, not September and October, October and November. Sorry, not September and October, October and November, October and November. 5 lakhs into 16% into 2 by 12, that is 13,333. And this is 10,000. So interest 66,667 plus 6,250. 333, it is 96,250 is the interest. If I calculate only for that 4 months, only during the construction period. And weighted average borrowings, I'll take 20 lakhs into, I'm calculating the interest only for 4 months means weighted borrowings also for 4 months. So 20 lakhs into 4 by 4. It is outstanding for entire 4 months. 5 lakhs into 5 lakhs was outstanding in the month of September, October, November. 3 by 4. And this is 1 by 4. So 5 lakhs into 3 by 4. 3 lakh 75,000. 7 lakh 50,000 into 1 by 4. 1 lakh 87,500. So 20 lakhs plus 3 lakh 75,000 plus 1 lakh 87,500, 25 lakh 62,500. So 96,250 is 4 months interest. So during that 4 months, what is the amount of loan? I have done the calculation here. Yeah. 96,250 and 25 lakh 62,500. So it is 3.75%. Is it per annum? 3.75% for 4 months. Are you okay? Okay, that is specific borrowing, general borrowing. If it is specific borrowing, we just go for actual interest. If specific borrowing, we'll go for actual interest. And if it is general borrowing, we find out weighted average borrowing rate, that is capitalization rate, and we'll apply on the expenditures incurred. Are you clear? So in this case, if you want to know what is the borrowing cost to be capitalized, that is not asked. What is the amount of borrowing cost to be capitalized? So first September, you spent 1 lakh. So 1 lakh into 3.75% into 4 by 4. If it was 11.09% into 4 by 12. If you are taking 11.09% into 4 by 12 or 3.75% into 4 by 4. Then 2,50,000 I incurred in the month of October. So November, December into 3.75% into 3 by 4. This is 4 months interest rate. Then again 2,50,000 into 3.75% into 2 by 4. Another 2,50,000 into 3.75% into 1 by 4. This is the amount that needs to be capitalized. So that is not part of the answer because that's not asked. The question is only compute the capitalization rate. Okay. I hope that is clear. Now I want to try last one more question. This is again your study material. Yeah, this question. Question number 6. TYK, test your knowledge question. We'll try this question and move on to the next areas. What next areas? We are doing Ind AS 23 borrowing cost. We know what is borrowing cost, what is a qualifying asset, what is substantial period of time, what is the treatment of borrowing cost. If it is related to a qualifying asset, it can be capitalized or else it will be charged to P&L. How do you compute borrowing cost to be capitalized? For the purpose of calculating the borrowing cost, we are dividing the borrowings into two: general borrowing, specific borrowing. Specific borrowing, there is a rule. General borrowing, there is a rule. That is what we are doing. Okay, let's do this question number 6. Another test your knowledge question. On 1st April 2011, entity A contracted for the construction of a building for 22 lakhs. Entity A contracted for the construction of a building for 22 lakhs. The land under the building is regarded as a separate asset and is not part of qualifying asset. Of course, we are constructing a building. Building takes substantial period of time for its intended use. The building was completed at the end of March. So when did you start the construction? 1st April 2011, and the work completed on 31st March 2012 means substantial period of time. During the year, okay, 2 lakhs, 6 lakhs, 12 lakhs, 2 lakhs, total 22 lakhs you incurred for the building. Correct. Entity A's borrowings at its year end, 31st March 2012 were as following. Okay, as on the closing date, these are the borrowings they have. 10% 4-year note, 10% 4-year loan with simple interest payable annually, which relates specifically to the project. What do you understand? So this is a specific borrowing. This is a specific loan. Debt outstanding at the end of the year is 7 lakhs. Interest of 65,000 was incurred on this borrowing during the year. Interest income of 20,000 was earned on these funds while they were held in anticipation of payments. So there was a delay in payment. So we had some idle fund which we invested, on which we received an interest of 20,000. So how much is the borrowing cost you can capitalize? I have studied, in case of specific loan, take the actual interest minus interest earned. So borrowing cost that can be capitalized is 45,000. Okay. Now there is a 12.5% 10-year note with simple interest. Debt outstanding 10 lakhs remained unchanged during the year. They have not specifically mentioned that it is specific loan. So we'll take it as a general borrowing 10 lakhs. And 10% 10-year note with simple interest outstanding at 1st April 15 lakhs, amount unchanged, which means there is no repayment. What is the borrowing cost that can be capitalized? So I'll understand there is one specific loan and two general borrowings. If there are two non-specific or general borrowings, we need to calculate capitalization rate. And I hope capitalization calculation and all is very clear to you. So, but still, I'll do the computation here. How do I calculate this capitalization rate? 10 lakhs into 12.5%. 1,25,000 and 1,50,000 divided by, what is the total loan? 25 lakhs. 25 lakhs. So general borrowing is, capitalization rate is 11%. So what will you do? So you had a specific borrowing of 7 lakhs. So first 2 lakhs payment will be out of specific borrowing. Next 5 lakhs out of specific borrowing. So here I'll take 1 lakh. I hope it is clear. 2 lakhs out of specific. Of this 5 lakhs is also out of specific. 1 lakh general borrowing. So 1 lakh into 11% into that we spend on 30th June. So July, August, September, October, November, December, January, February, March. 9 months. April, May, June illa 9 by 12. $8,250. December 12 lakhs into 3 by 12. 33,000. 31st March 2 lakhs. So 31st March year end I spent. So 41,250. 41,250 plus 45,000. So what is the borrowing cost that can be capitalized? 86,250 is the borrowing cost that can be capitalized. So first they have taken full 65,000, then 41,250 and then deducted interest income. 86,250 is the borrowing cost that can be capitalized. Are you clear? Are you okay? Yes, hopefully yes. Do you need to try one more or the last specific? Let's do this one. This question number 7. This is again study material question only. With this, we can close specific general borrowing discussion. K Limited began construction of a new building. Cost is 7 lakhs. To finance construction, we have a specific loan of 2 lakhs. And there are 2 general borrowings. So, very similar to what we have done just now. Yes. And construction, and these are the expenditure incurred. Construction completed on 31st January. That is the only difference. Construction is only not for entire 12 months. Construction completed by 31st January. If construction completed by 31st January, my capitalization period is only February and March, 2 months I cannot capitalize because work completed by 31st January, only during the construction period. So my entire calculation is that, like, first we computed the weighted average borrowing rate, okay, capitalization rate. Even specific borrowing, I will do only 10 by 12. Capitalization, actual interest I'll calculate only for 10 months. Because last 2 months there is no work, asset is completed, no more capitalization. That is the only change, rest everything is fine. So I think if you can go through, that is manageable. So we can move on. So where are we? We have few more theoretical areas to finish. So Ind AS 23, borrowing cost, we have done up to this. And we tried the questions. Now commencement, easy areas. Commencement of capitalization 4. When can you commence capitalization? When can you commence capitalization? If I have taken a loan, okay, and there is interest accrued on the loan, and there is a construction activity going on, when you can commence capitalization. So you need to write these 3 points. Commencement of capitalization. Capitalization should commence from the earlier date of satisfying all the 3 conditions. All the 3 conditions. When this 3 conditions are satisfied, on that date we can capitalize, we can commence capitalization. 1. Expenditure incurred on qualifying asset. expenditure incurred on qualifying asset. What is this? Expenditure incurred on qualifying asset. If you have taken a loan on 1st April, but you started spending the amount for the qualifying asset only on 1st June, then work started only on 1st June. Expenditure incurred, work started, let's assume, on 1st June. Then your capitalization can be commenced only from 1st June. Expenditure incurred on qualifying asset, borrowing cost incurred, and activities in progress for making the asset ready for intended use. Activities are in progress. Expenditure is incurred on qualifying asset. Borrowing costs should have incurred. Activities are in progress for making the asset ready for intended use. If all the three conditions are satisfied, if all the three conditions are satisfied, you can start capitalizing. You can start capitalizing. Expenditure should have incurred on qualifying asset. Borrowing cost should have incurred. Activities are in progress for making the asset ready for its intended use. If all the three conditions are satisfied from that earlier date of satisfying all the three conditions, then capitalization can be commenced. So I'll take you to a question. For understanding, I'll take a question. So there is an example in your study material which I'll read. X Limited is commencing a new construction project which is to be financed by borrowing. The key dates are as follows. 15th May, loan interest relating to the project started incurring. So 15th May, borrowing cost started incurring from 15th May. 2nd June, technical site planning commenced. Okay, some work started. 19th June, expenditure on the project started incurring. 18th July, construction work commenced. Identify the commencement date for capitalization of borrowing cost. So borrowing cost started incurring from 15th May, but there is no activities and there is no expenditure. 2nd June, technical site planning commenced means work started. Administration work started is also considered as work started. Then 19th June, expenditure on the borrowing cost incurred. So 19th June, in borrowing cost is there, activities are there, expenditure is there, construction work. Before construction work, there can be some planning work happening. So that is also activity. So borrowing cost can be commenced from, commencement date would be 19th June 2011. Are you clear? So just for that clarity, we did that example. Suspension. Now commencement is okay for me. Suspension of capitalization. When can you suspend the capitalization work? My capitalization started from 1st June, say for example, and work was there till 1st June 2012. But in between, capitalization is suspended, which means interest is incurred, but it cannot be capitalized. When? So this is the line which you should learn. Borrowing cost, capitalization is suspended during the extended periods when active work is interrupted. Active work is interrupted. When active work is interrupted, active work is not happening for last 2 months, work is interrupted, then borrowing cost capitalization is suspended. Now, if temporary delays are required for getting ready. For getting asset ready for intended use. There are some temporary delays, but the delays are required for getting asset ready for intended use. Then no suspension. Then there is no suspension. I want you to write like this: suspension. Borrowing cost capitalization is suspended during extended period when active work is interrupted out of avoidable reasons. If active work is interrupted, why it is interrupted? Out of avoidable reasons. You could have avoided that early. Example, there is a labor strike and 2 months work has not happened. In the study material example, they have given us we need to continue the work. We need a heavy plant and machinery, but it was shifted to another site. We need that asset back to continue the work. So all these are avoidable reasons. So work is not happening for 2 months means that is to be suspended. However, if there is a delay and that delay is required for getting the asset ready, then no suspension. That delay is required. Or unavoidable reasons like natural calamities, work cannot be suspended. But otherwise, this is the case when work is delayed, out avoidable reasons, then capitalization should be stopped temporarily. That is what suspension of capitalization. Okay. Now last one, cessation of capitalization. Capitalization should be ceased, stopped when substantially all the work is completed and asset is ready for its intended use. Substantially all the work. If there are some minor works pending, it's fine. Substantially, if the work is completed, capitalization. In 10 months, almost all the work is completed. Some extra electrical fittings are pending. Substantially all the work is completed, capitalization should be ceased. Okay, if asset is completed in part by part. So I'm constructing a flat of which ground floor is completed, people started occupying, first floor is completed, only second floor is pending. Then capitalization related to that ground floor and first floor can be ceased. So if asset is completed in part by part and if completed part of is capable of using independently, then capitalization of that part should be ceased. If the assets are completed in phase by phase, first phase work is done, second phase work is done, and it is started operating, then capitalization related to that part can be ceased. So if asset is completed in part by part and if its completed part is capable of using independently, then capitalization of that part should be ceased. So only from the date of commencement to the date of cessation, we can do the capitalization. So if there is a loan, yeah. Borrowing cost means from the date of loan to the date of repayment. But how much borrowing cost can be capitalized? From the date of commencement till the date of cessation. To the date of cessation. From the date of commencement to the date of cessation is the borrowing cost that can be capitalized. Only during this period, borrowing cost can be capitalized. So it is very important. So rest of the interest should be always transferred to, rest of the interest will be transferred to statement of P&L. Rest of the interest will be transferred to statement of P&L. And in between, if there is a suspension period, that suspension period interest is also transferred to statement of P&L. Are you clear? Are you okay? Now, meaning, treatment, types, commencement, suspension, cessation. Capitalization of borrowing cost by group companies. Is there a change if while preparing consolidated financial statements, whether there is a change? And very important, treatment of exchange difference. These two areas we need to do. With that, we'll finish. Capitalization of borrowing cost by group companies. What are the provisions while preparing consolidated financial statements? Very easy. With the help of an example, we'll find out, but time being, steps. Consider all borrowings taken by each company in the group. Total borrowings. Take the total borrowings by all the companies in the group, holding subsidiary, all the companies, you take the total borrowings. Consider the expense incurred by each company on qualifying asset. Any intercompany profits within the group has to be eliminated. That we'll find out. And we'll find out the borrowing cost to be capitalized. That we'll try a question and find out. There is a good question in the study material which I used to say that question will be asked for exams. Yeah, question number 12 in page number 61. Listen. In a group with parent P, there are three subsidiaries. A real estate company, B, a construction company, and C, a finance company. There are three companies. There is a parent and three subsidiaries. Parent company has no operating activities of its own but performs management function for its subsidiary. So what parent company is doing? Parent company is like, I'm just taking care of my kids. I'm taking care of my kids. Financing activities and cash management in the group are coordinated centrally. Finance company is a vehicle used by the group solely for raising finance. Finance company is doing only, so parent is taking care of kids. Finance company is taking care of all the financial requirements. All entities in the group prepare Ind AS financial statements. Of course, then only we have relevance in our CA final level, right? The following information is relevant for the current reporting period. Real estate company, there is a borrowing of 10 lakhs with interest rate of 7% per annum. Okay. Expenditures on qualifying asset incurred 15 lakh 40,000. So there is a qualifying asset of 15 lakh 40 and my borrowing is only 10 lakhs. All construction works were performed by construction company. Amount invoiced to real estate company included 10% profit margin. Okay. Which means this is a real estate company. We incurred expenditure of 15 lakh 40,000 on an asset. But this work is done by my brother construction company, which is another subsidiary, right? So this construction company is charging 10% profit margin means this is at 110 into 10. 1,40,000 is to be eliminated as unrealized profit, which means construction company sold to real estate company or did the work for 15,40,000 of which 10% represents their income. So all the intercompany transactions are to be eliminated. So we should see the asset value as only 14 lakhs and not 15,40,000. Okay. Now, construction company, no borrowings during the year. Finance 10 lakhs of expenditure on qualifying asset using its own cash resources. So they have financed qualifying asset of 10 lakhs. Now, finance company raised 20 lakhs at 7% per annum externally and issued a loan to parent company for general corporate purpose at the rate of 8%. General purpose loan is given for 8%. Parent company used the loan from finance company to acquire a new subsidiary, not for qualifying asset. No qualifying assets apart from those in real estate company and construction company. So please, I want you to read the question by yourself first. Can you please go through the question by yourself, that question number 12? So here it is very simple. What is the answer? Take in consolidated financial statements, find out total qualifying assets. Total qualifying assets. 15 lakh 40, I'll take only 14 lakhs. I'll eliminate the intercompany profits, 14 lakhs. Real estate company, 14 lakhs. Construction company, there is a qualifying asset of 10 lakhs. They are saying They used on funds for qualifying assets, but in CFS, all these are not separate companies. So find out how much is the total value of qualifying assets during the year. 24 lakhs. Now, what is the total borrowing? Borrowings of the group. Total borrowings, there is a borrowing real estate company, 10 lakhs. Here there is no borrowing. Here there is a 20 lakhs borrowing. So total borrowings of 30 lakhs. So they have taken borrowing at 7% and given at 8%. I will not consider 8%. Their incomes and all will be eliminated. So 30 lakhs borrowings and 24 lakhs qualifying asset. So qualifying asset that can, borrowing cost that can be capitalized is 24 lakhs into 7%. 1 lakh 68. Borrowing cost to be capitalized in CFS is 1,68,000. To this qualifying assets, 1,68,000 should be capitalized. Easy. Let me read the answer. So here, what is the amount of borrowing cost to be capitalized in the financial statements of each of the four entities? Oh, four entities they are asking. Following is the treatment as per Ind AS 23. Finance company. Let's all take finance company. In the books of, in the separate financials of finance company, raised 20 lakhs and given loan. So no qualifying asset. So no expenditure on qualifying asset. So in the separate financials of finance company, nothing is capitalized. Real estate company. Let me take real estate company. Borrowings 10 lakhs, qualifying asset 15 lakh 40. So 10 lakhs into 7%. In the separate financials, 10 lakhs into 7% can be capitalized. Construction company. Construction company, in the separate financials, there is no borrowing. They have qualifying asset. They have qualifying asset, but no loan. Okay, in CFS, total borrowing 30 lakhs. Then total interest 2,10,000. Eliminate URP. So cost is 14 lakhs. Total 24 lakhs. Total interest expenditure of the group are higher than borrowing cost capitalized. Therefore, only 1,68,000 can be capitalized. In CFS, 2,10,000 is the total interest, of which 1,68,000 can be capitalized, and balance 42,000 is what charged to statement of P&L. So there is a question, and this is an area which has not tested for exam. It can be asked. Okay. And the last area in this borrowing cost is exchange differences. Borrowing cost that can be capitalized includes treatment of exchange difference. So what is the connection between this exchange difference and borrowing cost? When there is a foreign currency borrowing. When there is a foreign currency borrowing, how do you calculate the borrowing cost to be capitalized? So these are the steps to be done. Step number 1. So you should follow this 5 steps to find out the borrowing cost to be capitalized. We should study this as 5 steps. Let's find out. About you have a foreign currency borrowing. First, we'll write the steps. Then we'll read a question as an example and then try out, discuss in detail. So first step, compute interest payable in foreign currency. Compute the actual interest. Actual interest. Compute the actual interest payable. Okay, fine. First step, compute the actual interest payable. If you have a foreign currency borrowing, find out the actual interest payable. Okay, fine. 2. Compute the interest payable if loan was taken in India. If loan was taken in India. If loan was taken in India, what was the interest payable? Compute the interest payable if loan was taken in India. Okay. Then determine or identify the difference. Identify the difference. Identify the difference. Either savings, interest savings. How it is interest savings? That's what we'll find out. Then compute increase in liability. Compute increase in liability. That is loan, foreign currency loan. Out of exchange difference. Borrowing cost to be capitalized is equal to step 1 anyway, because that is the actual interest, right? Step 1 plus step 3 or 4, whichever is less. I have no idea. What is this? What are the steps? Please explain. Yeah, let's explain. 3 or 4, whichever is less. I didn't understand a word. Please explain this to me. Okay, now listen. Question number 13 in page number 62. An entity borrows $1,000 at 4% for construction of a qualifying asset. An entity borrows $1,000 at 4% interest for construction of a qualifying asset on 1st April 2011. Okay. $1 is equal to 40. So when you have taken the loan, $1 is equal to 40. Up to this, are you clear? So you have taken a loan of $1,000. $1 is equal to 40, and the actual interest rate you have to pay in foreign currency is 4%. It could have been borrowed corresponding amount of funds in its functional currency, that is rupees. We could have borrowed the funds in our own currency, rupees, but the interest rate would have been 12%. So that is why you have gone for a foreign currency borrowing. Here the interest rate is 12%, but outside India interest rate is 4%. On 31st March 2012, exchange rate $1 is equal to 50. On 31st March 2012, year ending date, $1 is equal to 50. Compute the borrowing cost to be capitalized for the construction of plant. Also compute the adjusted borrowing cost in each of the following cases. So following cases let's leave for the time being. That is for more understanding. First, let's take this as an example. So please listen. Um, let me apply. Answers are given, but first let me try it. First case. So we have 5 steps, right? So my step number 1. What is the actual interest payable? $1,000 into 4%. When you are paying, your exchange rate is 50. Yes or no? At the time of payment, year end, when you make the payment, exchange rate is 50. So $1,000 into 4% into 50, 2,000. This is the actual interest. Okay. What is the interest if the loan was taken in India? If the loan was taken in India, I would have taken 40,000 rupees. Yes or no? If the loan was taken in India, I would have taken 40,000 rupees and my interest rate would have been 12%. So 40,000 into 12%. It is 4,800. If loan was taken in India, my interest would have been 4,800. So how much is your savings? How much interest you are saving? 2,800. So it was a right decision. You have taken loan from outside India. Your actual interest is only 2,000. Whereas if you have taken the loan from India, your interest is 4,800. So you literally saved 2,800. Now don't stop. What is my next step? Next step number 4. You saved 2,800. Now, because you have taken loan from outside India, your exchange rate has fluctuated, and 40 rupees was the exchange rate on um, 1st April 2011, but end of the year your exchange rate has become 50. So how much is increase in liability? Oh my God, my liability. Earlier for $1.40 to repay, now I need to repay 50 per dollar. So what is the increase in liability? 1,000 into 10. 10,000. Oh my God. So you incurred for this borrowing 2,000 plus 10,000 is your expenditure. 12,000 is your expenditure. But if the loan was taken in India, only 4,800 would have been the expenditure. Are you all listening? Anyway, so we are asking, can we capitalize this 10,000 also? Can we capitalize this 10,000 also? Ind AS 23 says no, that is not possible. Borrowing cost that can be capitalized is step 1, 2,000 plus the savings or increase whichever is less, that is 2,800. So maximum borrowing cost that can be capitalized is 4,800. Are you understanding? If the loan was taken in India, what would have been the borrowing cost? Up to 4,800 you can capitalize. So this 10,000 minus 2,800, that's 7,200 exchange difference should be charged to statement of P&L. Okay. Yes. Now, something very important. Also compute the amount to be adjusted at 31st March 2013 in each of the following cases. 31st March 2013. So here, first year, that is, we have taken the loan on 1st April 2011. And first year ending, what is the treatment? Is what we have done. Okay, so this is exactly your study material examples. Study material illustration, which not illustration, it is given as an example. But I find this example very important. Study material example only. So please listen. Okay, so second year, 31st March 13. If exchange rate is $1 is equal to 48. If exchange rate is $1 is equal to 48. I'll calculate, I'll do the same step. Assuming $1,000 is not repaid, $1,000 into 4% into 48. So this is second year ending. $1,000 into 4% into 48, 1920. Okay. What if the loan has taken in India? Same, 40,000 into 12%, that is 4,800. Then 3. What is the savings? Savings 1920 minus 4,800. Savings is 2,880. Okay. Now, 4. Increase in liability. Subsequently, second year, increase in liability when I checked. Last year, my liability was reported at $1,000 into 50. Yes or no? First, last year, $1,000 into 50. Now it is $48. So it is not increase in liability. It is an exchange gain of 2,000. Yes or no? Exchange gain of 2,000. Exchange gain of 2,000. It is a gain. Now, how much is the borrowing cost to be capitalized? Very important. How much is the borrowing cost to be capitalized? If it is exchange gain, amount to be capitalized is 1,920. Okay. it's not done, not finished. Now listen carefully. 1920. If it was first year, last year, either on 31st March 2012, if there was an exchange gain, it would have been transferred to P&L as income. First year ended, if there was an exchange gain, it would have been transferred to P&L as an income. It won't be adjusted against, it won't be deducted from the value of asset. It would be transferred to P&L as an income. 31st March 2012, please focus. And 31st March 2013, again if there is an exchange gain, it will be transferred to P&L as income. Borrowing cost is only 1920, and the gain would be transferred to P&L as income. However, so first year if it was a gain, it would have been transferred to P&L as an income. Second year also if it was a gain, it would have been transferred to P&L as an income. But however, here in this case, 31st March 2012, it was an exchange loss. It was an exchange loss of 10,000, of which 2,800 is considered as borrowing cost, and we added to the value of asset. Yes or no? And we added, it is considered as borrowing cost, and we added to the value of asset, and balance we charge to statement of P&L. Are you all focusing? Is it clear? Yes. Now on 31st March 13, listen, what my standard says is there is an exchange gain of 2,000, and last year it was an exchange loss of 2,800. Last year's exchange loss 2,800 you added to asset. Now subsequently if there is an exchange gain, up to 2,800 should be adjusted against borrowing cost, that should be deducted from the asset. Are you understanding? First year it was an exchange loss. First year it was an exchange loss of 10,000, of which 2,800 you treated as borrowing cost and added to asset. And then subsequently up to 2,800 gain should be considered as an adjustment to borrowing cost and deducted from the asset. Which means in this year 2, when exchange rate is 48, borrowing cost you can capitalize 1920, but deduct from the asset 2000. Adjust this against borrowing cost, and to that extent it will be shown as a deduction from the value of asset. Did you get that? I'll show you once more. See, this is, as I said, this is the example given in your study material. If the exchange rate on 31st March 13 is 48, listen, focus. The exchange rate on 31st March 12, the same thing I have done in the book, but still, being $1 is equal to 50, the borrowings are still not due for payment. The entity will recognize a borrowing cost of 1920. There is an exchange gain of 2,000. This will be adjusted in the borrowing cost as there is unrealized exchange loss, and the adjustment is less than the exchange loss of last year. You recognize 2,800 as borrowing cost and you added to the asset. So 2,000 gain in the current year should be adjusted against the borrowing cost, because unrealized exchange loss of last year is 2,800. Up to 2,800 you can do the reverse adjustment. Is it okay? So if there is a doubt, as I told you, please comment below. I'll respond. Now the next case. What is the next case? If exchange rate is 44. If exchange rate is 44. If exchange rate is 44, step 1 as usual, actual interest. Step 1 as usual, actual interest. Actual interest is $1,000 into 4% into 44. How much? 40 into 44, it is 1760. Then 2, if loan has been taken from India, it is 40,000 into 12%. So 40,000 into 12%, it is same 4,800. Then interest savings is 3,040. Then 4, increase in liability. It is not increase in liability. It is again an exchange gain of last year $1,000 I closed at rupees 50 and now it is 44, which means 6 rupees gain. There's an exchange gain of 6,000. Now tell me what is the treatment? Last year, 31st March 2012, how much is the exchange loss you capitalized? 2,800. Up to 2,800, you can show as an adjustment against borrowing cost, adjust against the asset. Balance will be transferred to P&L as gain. Yes. The entity will recognize a borrowing cost of 1,760, exchange gain of 6,000. This will be adjusted the borrowing cost up to 2,800 and balance that is earlier adjusted. Balance understood, it will be transferred to P&L as income. Okay. Then there is one more. As I said, it's just a copy paste in the last one. If the loan is repaid. So loan is repaid to the extent of $600. So I'll read the situation first. Case. What is the last case? The last case given, if 600 of the loan is repaid, last year itself you repaid 600, and that is again one more adjustment, one more area. If 600 is repaid, then what is the treatment? Just focus. My actual interest will be, if 600 is repaid, $400 into 4%. Why should I do? It's given into 44, 704. Please do the calculations in your book. Just check the calculation, 704. Then, so this is my actual interest. Okay, fine. Then here there is gain anyway. There is gain. So exchange gain is $400 into 6, 2,400. Last year exchange loss capitalized is 2,800. So what is the treatment of this 2,400? Now, because the loan is already a proportionate part is paid, what we do is 2,800 was the exchange loss when the loan was $1,000. Now the loan is only $400. So 2,800 divided by 1,000 into 400, 1120. 1120 can be adjusted. Out of 2,400 gain, 1120 will be adjusted against, that is loan reduced 2,400. To asset you can adjust up to 1120. Balance will be transferred to P&L. So again, this part is not asked for exam. It is given as an example. So please focus. I feel this is an important area. Okay. Yes. Now the last question in the material. ABC Limited has taken a loan of $2,000. Interest rate is 5% per annum. There is a loan of $20,000. Now let's take this question in the study material. Last question. There is a loan of $20,000, 5% interest rate. On 1st April 2011, the exchange rate is 45. The exchange rate has become 48. If the loan was taken in India, the interest rate would have been 11%. Compute the borrowing cost to be capitalized and what is the treatment of exchange loss. So actual interest, $20,000 into 5%. At the time of payment, it is 48. So $20,000 into 5% into 48, 48,000 rupees. 2. If the loan was taken in India, 20,000 into 45 is the Indian rupees we would have taken, 9 lakhs. Exchange rate is 11%, that is 99,000. Interest if loan was taken in India, 99,000. So how much is your savings? Because you have taken loan from outside India, how much is your savings? 51,000 is your savings. Now increase in liability. Increase in liability. Increase in liability is 20,000 into 3. So if it was an exchange gain, it would have transferred to P&L. First year itself, if it was an exchange gain, it would be transferred to P&L. But subsequently, if there is an exchange gain, adjusted against exchange loss already capitalized, and only balance can be transferred to P&L. Are you clear? So here, how much is the borrowing cost that can be capitalized? 48,000 plus this 3 or 4, whichever is 3 and 4, whichever is less, 51,000. Borrowing cost that can be capitalized as 99,000. Okay. And there is an exchange loss of 9,000 which will be transferred to P&L. So I think this is this question. Yeah, illustration 6. Okay. So first step is 48,000 actual interest, 99,000, 51,000 savings, increase in liability. Yes. So that's it. So these are the areas in Ind AS. Which standard? Ind AS 23. Borrowing cost, qualifying asset, substantial period of time. We need to be very clear. You should write the lines if you get a question. Treatment of borrowing cost, always capitalized if it is for qualifying asset, but there are some conditions. Other cases, P&L. Borrowings are of two types, specific borrowings and general borrowings. So conditions, what are the conditions? Only from the date of commencement till the date of cessation, and in between if there is a suspension due to an avoidable reasons, that is to be charged to P&L. If there is group companies where you are preparing consolidated financial statements, you need to find out total borrowings and total uh, qualifying asset. Accordingly we'll calculate. And treatment of exchange difference in case of foreign currency borrowings. So these are the total areas in the standard, a very easy and small standard. I hope it is clear. As I told you multiple times, if there is a doubt, you can comment below, that I'll clarify. We'll discuss another Ind AS in the next video. Thank you.